Hello and welcome. This is All You Need to Know. I'm Agam Bakil. Let's start off with the global markets and see how they're panning out in trade and perhaps the influence they can have on Indian markets. But at this point in time, we're seeing mixed cues from the US markets, which closed marginally in the red for the most of the indices, except for the Nasdaq, which advanced by as much as 0.5%. The European indices, however, did see some substantial weakness come through. And when it comes to Asia, again, we're trending lower at this point in time. In fact, the Hang Seng is down by as much as nearly 1%. So we'll watch out for these cues as we move to trade. But when it comes to the SGX Nifty at this point in time, we're largely flattish, not too much to speak for. And when it comes to our own markets yesterday, well, as you can see, the Nifty were closed flat, and it was the same for the mid cap and the small cap indices. But when it comes to some of the other sectoral movers, we did have some weakness in the Nifty Banking Index, but the Nifty PSU Banking Index advanced by as much as 0.5%. Let's take a look at some of the other indices too. The Nifty Pharma Index advanced by around 1.3%. Some strength in the Nifty IT Index too. And when it comes to the ADRs, at this point in time, we are seeing the most amount of strength in Tata Motors. That's followed by Dr. Reddy's, Infosys and HDFC Bank, all of them advancing, but less than 1%. And on the losing end, we have some weakness in Vedanta, ICICI Bank marginally in the red. Let's also take a look at foreign institution flows and outflow of around 96 crores on a net basis, and it's the same for DIIs, around outflow of around 562 crores on a net basis. And let's bring in the contributors then for the Nifty. We have TCS, ITC and Reliance Industries, looking at a little bit of an up move and providing some amount of support to the Nifty, but HDFC, Twins and ICICI Bank bearing down on the index. That said, let's pull up the futures and options space too, and we continue to see accumulation in the Nifty futures. On the other hand, the Nifty banking futures continues to see longs unwind. Once again, another 11% unwound when it comes to its open interest. When it comes coming down to your range that we're looking for on the Nifty, it is the 11,000 put, as you can see here, and the 11,500 call, which has the maximum open interest at this point in time, and that should determine your near-term range for the Nifty as we move in. But when it comes to changes in OI, well, it was the 11,400 strike which was the most active, considering we saw the most amount of writing around the 11,400 calls as well as puts. But let's also take a look at the Nifty put call ratio, and that really hasn't changed at around 1.7. The Nifty banking put call ratio, however, has fallen even further to around 0.96. And among other stocks we're keeping an eye on, KPIT Technologies see fresh longs, 16% addition in open interest, and we're also seeing fresh longs in Bata India, where we have seen the underlying move up by as much as 3.5% with accumulation in OI. And on the other hand, on the losing end, we have weakness in Tata Global Beverages because of the weakness coming on account of earnings, 11% added towards fresh shorts. So we'll be watching out for these as we move into trade today. But now let's go across to Bloomberg's Paul Allen for the top international headlines.
US automakers paid the price for pulling back on discounts for the first time in more than 4 years. Almost all reported sales declines last month, led by a 15% plunge at Nissan. The drop in sales caps a rough month. Detroit's big names all lowered their earnings guidance, and Ford embarked on a 5-year restructuring plan. Car makers also faced the challenge of good deals on used vehicles. President Trump is back to saying that the best way to gain funding for his border wall is a government shutdown before November's midterms. He told radio host Rush Limbaugh that many Republicans disagree, but he thinks raising the pressure before the elections would force Democrats to support the plan. Senior Republicans fear a shutdown would help Democrats at the ballot box. The lira plunged to a record low as the US sanctioned 2 Turkish ministers over the continued detention of an American cleric. The Treasury Department says Turkey's Justice and Interior ministers have played leading roles in the arrest and detention of Pastor Andrew Brunson. President Recep Tayyip Erdogan says Turkey will not bow to what he calls an evangelist and Zionist mentality in the US. Google is said to be preparing a version of its search engine for China that will block results Beijing deems sensitive. I'm told the program is codenamed Dragonfly and is one of several options Google is pursuing for returning to China. The news hit Baidu, shares raising an earlier earnings-driven gain. The stock had seen a pre-market rise of more than 2% after beating revenue and profit forecasts. Global news 24 hours a day on air and at TikTok on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Paul Allen. This is Bloomberg.
It does seem that September rate hike is baked in the cake. The Federal Reserve in its policy statement really just the one-word changes here and there, but the one-word changes are in the direction of this economy is at least as strong as we thought, certainly healthy enough, inflation doing well enough for us to incline and do that September rate hike as is so widely expected. The question about December, of course, is there's a few months till then. What happens to the yield curve? What happens to inflation? And I think a very interesting question is if the Fed risks raising that key rate too much. For this, we're going to jump now into a Bloomberg chart from our GTV library, and it looks at a key measure of the neutral rate. That's the white line across the top, Laubach-Williams, and underneath is the blue rate. It's the effective Fed funds rate. Most important is look how much closer the blue line, the Fed funds rate, is to the neutral rate. If you keep hiking rates and move above that neutral rate, as the Fed has said it intends to pretty much, do you risk doing too much? Well, just in the last hour, we spoke to Vince Reinhart, former head of the Division of Monetary Affairs at the Federal Reserve Board of Governors for many years, chief economist at Standish Asset Management, and this is what he said about the risks that he sees rising this year and next.
They're trying to do a hard thing. Actually create monetary restraint. They're going to get to a point where they're no longer just removing accommodation funds rate below its neutral rate. They actually envision putting the funds rate above its neutral rate. That's hard to do, hard to get right, raises recession risks, but they're going to hope that they get enough signals.
Shifting focus to currency and bond markets, the Indian rupee yesterday ended at a fresh two-week high at 68.43 levels against the dollar, even as RBI hiked the repo rate by 25 basis points. Now, central banks' upbeat comments largely supported the positive sentiments in the foreign exchange market yesterday, while a sharp fall in crude oil prices overseas predominantly supported the rupee's up move. Well, the bond markets too reacted positively after RBI maintained its neutral stance despite a rate hike, and hence we have seen the 10-year benchmark bond yield dropping nearly 7 basis points to end at 7.7%. On the global front, dollar held modest gains against major currencies yesterday after Federal Reserve left its key rates unchanged. However, they reiterated a plan for gradual rate hike on the back of strong US economy. That apart, both euro and pound erased gains against the dollar and ended little changed yesterday. And lastly, speaking of dollar rupee, now it is trading at 68.30 levels against the dollar in the non-deliverable forward markets, which indicates a positive opening for Indian rupee in today's trade.
Well, most of the brokerages believe that the RBI is done with its rate hike, at least in the near term. You have Kotak Securities, which says that the RBI retaining its neutral stance suggests that the rate hike cycle from here onwards will be a shallow one. In the base case, they're expecting RBI to pause in the near term. However, they do continue to believe that there is a probability of further rate hike over the next 12 months. Nomura says that because the RBI has now front-loaded the hikes, they're expecting rates to be unchanged for the time being. But when it comes to the Indian rupee, they continue to maintain their cautious stance in line with the stance that they have on the region. UBS says that the headline in CPI inflation has peaked out in June, and they expect it to head lower over the next 6 months, even as the favorable base effect will start kicking in. But they do say that if the CPI inflation sustains above that 4% target of the MPC, then that would call for more policy tightening. But in their base case, they're expecting MPC to go for an extended pause over the next 6 months. You have Citi, which has said that the hiking cycle may not be over yet because there is no visibility of the RBI being able to meet its 4% inflation target in the forecast horizon. They have penciled in another 25 to 50 basis points hike for FY19, but they do expect RBI to skip any hikes in October policy, at least because they believe it will wait for the lag transmission of the 50 basis points hike that they have done so far. Finally, you have Morgan Stanley, which says that because of the growth recovery which is on track, and inflation forecast which is expected to rise, they're expecting one more hike, and that too in the October policy meeting. Further rate hikes, they say, are contingent on the inflation outlook. So you just have Morgan Stanley, which believes that there's another rate hike coming in October.
When it comes to the kind of scenario for the banking industry in terms of interest rate hike, I think more than the policy, it is also a function of the demand and supply. and also if at all there is a credit demand, right kind of a credit proposals are there, all the lenders are there to offer at very, very competitive rates. So I think per se it will, for the right kind of a lending opportunity, I don't expect any kind of a experience in terms of hike in interest rate. That's what my sense is.
The underlying message is that while acknowledging the current price momentum pressures, be it through crude or be it through the recalibrated MSP hikes, as also, the very evident core inflation momentum, a rate hike was almost given, in our opinion. Going forward, with so many uncertainties around, it could work in either direction, and I think that's the most appropriate way to go about at such times of high volatility and high degrees of uncertainty.
Let's now get your check on the commodity space, which the entire basket seems to be under pressure, starting off with oil prices, which did decline about 1.6% in overnight trade, and WTI is now trading very close to the 68 per barrel mark. A few factors that have led to the downfall in oil prices, one of course the supply concerns and the trade war concerns that have been that have in fact resurfaced. The other factor that in fact led to the downfall in oil prices was the surprise inventory buildup that we got. So EIA in fact has reported an inventory buildup of about 3.8 million barrels for last week. Now this is despite the fact that Saudi Arabia and Russia have pumped in more than what they did last month. In fact, Saudi Arabia has pumped more oil than it has ever. But shifting focus to the base metal space, the index itself on London Metal Exchange declined about 2% in trade. All of the major base metals declined in trade on the back of resurfacing of the trade war concerns. Nickel closed lower by 3%, which was the top loser in trade, and it was the first time in 7 days that it saw a decline. Zinc and copper declined more than 2% each, while the likes of aluminium, lead and tin had cut off about more than 1% each. Now, if you look at the Shanghai Futures Exchange, the base metals are in fact trading with a negative bias, led by Shanghai Steel, which is trading close to 2% lower. Gold prices too were under pressure, declined about 0.5% on the back of a surge in the dollar index that we saw in the overnight trade.
Well, amongst the stocks that we're tracking in trade today include a couple of companies which came out with their June quarter numbers after market hours, starting off with HEG, which reported a very strong set of numbers, a revenue growth of 7.7 times. EBITDA increased significantly to nearly 1,200 crores and EBITDA margins expanded from 11% to 74%. In fact, the company reported a net profit of 770 crores in this quarter as compared to a marginal loss in the corresponding quarter last year. Next on the list is Jindal SAW, where revenues grew by a strong 63%. Net profit growth came in at about 50%. Even if you look at the operational performance, EBITDA margins expanded slightly by about 40 basis points. You also have V2 Retail, which reported numbers of very strong top line growth, revenue growth of 32%, net profit growth came in at 29%, and you saw EBITDA also increase by about 29%. However, it was a disappointing quarter for Triveni Engineering, with revenues dipping by 12% and the net profit seeing a much sharper decline of 38%. Even if you look at the operational performance, EBITDA margins came off to just about 10%. We also saw a weak set of numbers coming in from Reliance Infra, a muted revenue growth, but the net profit fell by about 19%. And even if you look at the operational performance, EBITDA margins came off from about 27% to 23.8%. That apart, we are also watching out for companies which reported their monthly sales for July. You have Hero MotoCorp, which reported a 9% growth in the sales volumes, more or less in line with what the street was estimating. Next on the list is Eicher Motors. This was a slight disappointment, year-on-year growth of 7% to 69,000 units as compared to an estimate of 75,000 units or so, so slightly below expected numbers for Eicher. And then finally you have Tata Motors, for which the domestic sales grew by about 21% in the month of July. That apart, you also have L&T Technology, which will be in focus. This is because the parent company L&T has offered to sell 4% stake in the company. The float floor price has been fixed at 1400 per share as compared to yesterday's closing price of 1487. So we might see some downtick pressure in on this counter today. And lastly, you have GPT Infra Projects. They've bagged a railway construction order worth 362 crores. This is the single largest order by value that they have won. A low volume stock, but could react sizably. So watch out for these names.
The oil major ONGC is expected to report a strong set of numbers in the first quarter of financial year 2019, purely on the back of higher commodity prices. Now, the revenue of the company is expected to be higher by close to 12% to close to 27,000 crore rupees, while the EBITDA is expected to see a sharp jump of around 69% compared to last quarter to close to 14,000 crore rupees. Margins are expected to be around 52%, while the net profit is expected to be higher by 13% to close to 6,700 crore rupees. Now, the net realization is expected to come in at around $72 to $74 per barrel versus $66.7 per barrel reported by the company in the last quarter. Now, the quarter was aided by higher oil prices and the gas prices. Now, Brent crude, that is the Asian benchmark, averaged around $75 per barrel versus $67 per barrel in the last quarter, while the domestic gas prices were higher by around 6% to close to $3.06 per million British thermal unit. Now, on the operation side, if you see, the crude oil production numbers are expected to be flat at close to 6.1 million metric tons, while the gas production is expected to decline by around 4% to 5.8 billion cubic meters. On the financial side, the subsidy burden is expected to be nil on ONGC in the first quarter, and because of which the company is expected to report a record high realization in this quarter, while the EBITDA is expected to see a sharp jump because the last quarter EBITDA was impacted by higher exploration costs and other expenses. Now, the reason behind a lower net profit growth rate when compared to the EBITDA growth rate is partially also because of lower other income and higher interest costs. Now, other income is expected to be lower because in last quarter the company received a dividend from its two investments, that is HPCL and IOCL, while the interest cost is expected to be higher because of the 31,000 crore debt taken for the HPCL acquisition. Lastly, key things to watch out for would include the oil and gas production volume numbers, the capital expenditure plans of the company, the development plans of the KG basin that the company has, clarity on funding of repayment of the debt related to HPCL acquisition, and any clarity on subsidy burden, if any, because of the petroleum subsidy will be a keen thing to watch out for in this earnings.
Well, it's expected to be yet another strong quarter for Indiabulls Housing Finance. According to Bloomberg estimates, the net profit is expected to see a jump of 28% to 1,009 crores. Loan growth trends are expected to remain steady with a loan growth of 30+% in line with what we have seen in the prior few quarters. The spreads, however, could continue to moderate given the mix towards core mortgages has been increasing, and that's an area where spreads have compressed sharply. Nevertheless, they're expected to come within the management's guided range. Asset quality trends expected to remain steady, so the gross NPA ratio is expected to come in within that 0.7, 0.8% sort of a number. So what is going to be important then to watch out for is going to be the incremental spreads and asset quality trends, especially on the corporate and the LAP portfolios. The AUM growth guidance, traction in the affordable housing finance for the company, and also the Ind AS impact on net worth and earnings, but overall expected to be a strong inline quarter.
Let's also get your check on the top 3 stocks to watch based on the delivery buying and selling as of yesterday. The first stock on the radar is Exide Industries. Now, that was down about 3.5% in trade yesterday and saw delivery selling in excess of 100 crores. The delivery volume that managed to rise about 150% as compared to its 5-day average, while the total volume surged nearly 3.5 times as compared to its 5-day average. Second stock to watch out for, Piramal Enterprises. Now, that was up about nearly 5% in trade yesterday and saw delivery buying of nearly 90 crores. The delivery volume more than doubled for itself, as did the total volume at about 108% as compared to its 5-day average. Last and final stock to watch out for, Tata Global Beverages. Now, that too was down nearly 4.5% in trade and saw delivery selling of 64 crores. The delivery volume surged about 127% as compared to its 5-day average, and the total volume surged more than 1.5 times as compared to its 5-day average.
Are screens disrupting childhood? In short, yes, but it's complicated. The average age for getting a first smartphone in the US is about 10, and half of all American and British kids have social media accounts by the age of 12. Smartphone-wielding teens and preteens are glued to their phones, often using social media to share sensitive data about themselves during what can already be a tough time navigating puberty or adolescence. There are worries that screen time and social media activity can be addictive, and researchers say it can lead to bullying and depression. A recent survey reported that 22% of 8 to 17-year-olds said they had been bullied online. But there's a flip side to this.
There's certainly evidence to suggest that kids can use their smartphone for up to 2 hours a day. Just like anything, if you have a drink with your friends, it's great. If you carry on drinking for 12 hours, it's probably not so great. But it's the responsibility of the parents to manage that. Certainly many parents want to throw the phone in the rubbish bin and make their kids play outside.
And parents aren't the only ones sounding the alarm bells. A group of pediatric and mental health experts are lobbying Facebook to discontinue Messenger Kids, a version of its messenger app for children ages 6 to 12. Most platforms do have age restrictions, but its honor system is virtually impossible to enforce. After pleas from 2 of its major shareholders to address device addiction, Apple has recently unveiled a new feature to help people take control of their habits.
We know this is something that can help families achieve the right balance for them.
Meanwhile, experts still can't agree as to how serious a threat all of this is.
Most of the evidence is relatively new on whether social media is a good thing or a bad thing.
Like it or not, social media and screens are here to stay, putting concerned parents in a difficult bind. Letting children too young to use technology and social media run amok, or risk isolating them from their peers.
Well, there's lots you'll find on the website bloombergquint.com over the course of the day. Of course, all the live market action, but there are also several interesting stories that you'll find here, just a couple of them. China's central bank has started actively encouraging banks to extend more credit by taking a softer stance on loan quotas. That's a Bloomberg report that quoted unnamed sources. This as authorities increase efforts to spur a cooling economy. The central bank hasn't provided specific targets, but it indicated a willingness to be more flexible on banks' government-imposed lending caps. Ratings agency CRISIL has downgraded the debt instruments of Reliance Infrastructure to D, which means either a default or an imminent default. This after the company missed interest payments. The move was prompted by its exposure to other companies under the umbrella of Anil Ambani's Reliance Group. That's all you need to know going into trade today. Do stay tuned though. Up next on Bloomberg Quint is Indian Open.